Okay. Uh, Others will join us as we progress. Once again, good evening. My name is Tayo Olatimilei, and thank you for making out time to be here tonight. I'll put on my camera in a moment. We will be looking at a few things to synthesize ourselves about money management and about investing today. Before we go on, I would just give a little bit of housekeeping and to let us know that you can put up your hand anytime to ask a question. And because this is a webinar style, you might not see other people on the call. If you want to ask a question, you are able to ask question anonymously, and I will try my best to pause and answer our questions as we ask them. If you want me to unmute you or to allow you to talk, please let me know. I'll be glad to give you the chance to use audio to ask your questions, or you can type in the chat directly either to me or to everyone, or you can also ask anonymously any question that you might have as we progress in this coaching. Okay. So today I will be showing us how you can build wealth while still working 9 to 5 jobs, and how you can retire early and comfortably. And we can see on the flyer that I mentioned a few things, uh, tax relief opportunities, and the building free income and investing strategies, becoming a smart investor with passive income and debt repayment strategy. I'm going to freestyle it a little bit today. Uh, um, I will freestyle a little bit today. Just jump around it, just for us to have that fundamental principles that we need to have to be able to build with, especially in a country like this. Before I continue, this discussion is for presentation and for educational purposes only, and should not be construed as investment advice because investment can go up and down in value, and past performances is not a guarantee of future returns. Okay, that out of the way. Yeah, we do this once every month. A free training that could give people basic foundations that they could use to start investing or manage their money better, especially when you are, like I've said, in a Western economy. And these are the kind of trainings we offer. And about myself, I regard myself as an investor. I don't teach what I have not been doing. I have over 20 years investing, building businesses, and this time around, I'm on a mission to help hardworking individuals and families to manage their money better and also to build wealth that will last across generations. I started with trading, which was like 2006, a long time ago, almost 20 years ago. But over the years, I've moved from that into proper investing. Trading is not investing. I'm no longer a fan of trading because of the level of risk involved. And so, what we'll be talking about today will not be anything along trading. Be investment, how we could manage our money better, and how we could make that money work for us while we still work 9 to 5, and the opportunities for tax relief that are available within the economy. Okay, we live in a capitalist economy. Obviously, it's obvious to us. The one funny thing is that labor is part of the means of production. And so if you're working 9 to 5, in the eyes of your capitalist, you are one of the means of production. I am one of the means of production. Land, raw material, machinery, factory, infrastructure, and people, labor are part of that raw material. And and it means that you are not considered so much as a owner, uh, so you don't share part of the profit as you're supposed to share. You get paid a salary. If you look at it in the context of how much the company is making or how much hour you put in, you know that what you are being paid is just a fraction. You can work in a place where you bring in a revenue of 2, 3, 4, 5, 6 million, and you're just paid 100,000 out of it. Even when the return on investment, or when the margin is up to 25% or 30% margin on what you are working on. So So, and again, another thing about the Western economy is that it's largely sustained by credit and taxation. Government borrow, the government will borrow and they keep borrowing, and then they keep increasing tax. Autumn statement is coming November 26th, I think. The autumn statement will be read. And then what are you looking forward to? More taxes and more taxes. Nothing much to positive to really look forward to than for the exchequer to find way to raid up our wallets a little bit more to finance whatever they want to finance. And that's the way the Western economy works. And another thing we need to realize is the Western economy is run on the back of this area of the middle class. It's run on the back of the middle class. The rich have options. People are moving to Dubai en masse now. People are leaving the country because of the attempt of the government to tax the rich. People are relocating, and then for tax purposes, UK will no longer be their even though their businesses are here, but UK will no longer be their home their residence for tax purposes. And so the people here are on benefit. The people here are super rich. They have options. They know how to legally or otherwise not pay as much tax. But some of us who are stuck in this middle class, we we run the economy. We keep the economy running through our purchases, our purchasing power, whether you borrow the money, whether it's on credit card, payday loan, buy now and pay later, personal loan, car finance. We are keeping the economy running. I won't play this video. I have a video here, but that is what I'm actually explaining right now. And people who are here, even though they are running the economy and they look okay financially because they are financially stable, uh, it's they are the most deceived part of the economy. Why? Because we believe everything is all right until it starts being all right. Until somebody is out of job for 3 months, or someone is out of job for 6 months, and they fall into financial crisis. And so, what do we need to do not to be a victim when issues happen around here? Is that you need income generating assets. And that's what we will talk about today. We need income generating assets that could replace our current income so that we don't be a victim
I want to quickly
of a gap, of a gap in in our employment and such or any other event that is beyond our control. Okay, let's move on. Let's move on. Yeah. So I'll speak. The one I skipped is the fact that we are meant to think transgenerationally. Despite what is going on with inheritance tax in this country, you're still meant to think transgenerationally, and there are ways around it. Which if we work together long enough, you will be able to understand a lot more. And why do we desire where that would trans that would go beyond us to people who are coming behind us? Is the fact that we are taking responsibility beyond having a comfortable retirement is the fact that God wants us to prosper. One, two, we have a comfortable retirement. Three, we are taking responsibility because God won't do for you. Neither will the government do for you what you can do for yourself. It's leadership. You have the background, okay, and then you have to take responsibility. Okay, how can you become wealthy? There are different ways you can become wealthy. You can win a lottery. It could be inheritance from from parents, from grandparents, or gifts that could worth 1 million. You could become an executive. You could start a business, but we know that a lot of businesses, and in fact, up to 70% of businesses will fail within their first 15 years. Even though we have your chances are higher here than playing lottery. But something that we can all do, which we are already doing, is being good at what we do. You're very good at your profession. Whatever training you've had, you're an engineer, you're a doctor, you're a teacher, or you're a business owner, or whatever it is, you're a carer, you're an IT professional, you've been trained and you understand your work very well. But what you now need to understand more is how can I put my income to work for me 247? How can I be better, get paid more, and then have my income work for me 247? And that would take us to some of these principles that we be looking at. We only look at one or two of them in the course of this training to coaching tonight. Just look at one or two of them. Financial education, very important. Like we are all here. Like I just said right now, you don't become a pilot by wishing, and you don't also become a doctor by wishing. You don't become an IT professional by wishing. You don't know. If you don't know how to configure a Cisco router, you don't know how to configure it. It's that simple. Again, and also you don't become proficient when it comes to investing unless you learn about it. We weren't taught in schools. Even we have people who study accounting and they don't understand investing because no one is not being taught in our schools, whether intentionally or otherwise. It's not being taught. So there's a place for us to seek knowledge from, especially from people who are practically doing the things we want to learn. And so very, very important that we have that. And let me just move on to this slide, and I will explain those three things. Financial education, I won't say more about that. The power of a seed, money management, and multiplier, multiple streams of income. I put in here for those of us who are Christians, we can go look at these references when we finish this training. You can take a screenshot shot. I'm going to upload this into YouTube also. You can actually take go back and look at those references. Okay, like I said, I'll move on from here. Let's read books, watch YouTube videos, but be very careful of who you also listen to. A lot of people are just out there in the media space, teaching probably what they don't have so much experience in, or just trying to make people feel good about it, and people end up losing their money. Uh, uh, if maybe you heard people talk about trading, yeah, I traded for years. Okay, so you can make money trading, but you can lose that money faster than you made it when it comes to trading, and it's probably not a way for somebody who's got a full-time job to go, because in itself it's almost a full-time job. If you don't trade, you don't make money. It's not passive. Okay. And so the next thing I'm going to talk about, which is fundamental, and if this is all I could talk about today and we get it, then you will be all right, is the power of a seed. The power of a seed. The power of a seed is talking about the fact that within your income, there is a seed. Now, I'm not talking about what you give out of your generosity, either to a place of worship or to other people, but what you have within your income is a seed. I'll play this video. Let me mute my sound because the sound is not really necessary when it comes to this. So I'm going to play this video so that it can register in our minds what I'm trying to explain here when I talk about the power of a seed. Okay. Let's have it. So you can see just one seed of pepper being put into the soil. It talked about process of time. Okay. It didn't the pepper didn't bring out fruit within a day or two. Okay. It took a few weeks, I would say months, about more than 3 months, there about the fourth month, and then we can see what's happening. A single seed turning to a tree. Let me pause it here. Turning to a tree and producing so many pepper here. So I say, imagine that this pepper is your salary. Just one is your salary. You get paid one pepper per month. What do you do with it? Do you grind it all? Do you cook it all? Do you eat it all? Okay. If we understand the concept that in every income that you receive on a monthly basis, there is a tiny seed in that income. If you understand that, you will be up, you'll be good when it comes to investing. That within every income that comes to you and to myself, there is a part of it that is not meant to be eaten, because It is the seed. And that seed is meant to turn into a forest if you know what to do with it. Okay. And it means that from every income that comes to you, no matter how little, a part of it must be put away. So your wage is your greatest wealth building tool. It means a part of it must be put away as a seed to be planted for you to harvest later in the future. Okay. I said that the law of seed and harvest time sustains the planet. If you look at this planet, there's nothing on this planet that will be recreated again. It's been created, and within it is the power for it to reproduce after itself. We have in human beings the seed for human beings to reproduce after itself. In animals, they have the seed for them to reproduce after themselves. For every plant that you see, there is a seed in them to reproduce after themselves. So also in your finances, in the money that comes to you, there is a seed in your finance that you must not eat so that it can reproduce after itself. Um, and with that, you are able to sustain your finance. So I put some a title there. The title looks funny. How never to run out of money. How not never to run out of money is the same thing. How never to run out of food. If you're a farmer, for instance, when you finish harvesting, you keep aside the choicest of your harvest as seed for the next planting season. And what do? You plant it when the next season comes. So if you eat everything, then when planting season comes, you have nothing at all to plant. And so, as every one of us, this every money that comes, you have these three components. You have the bread. This is what you eat. Okay, more than 80% of your income is meant for you to enjoy life, to eat, to pay for essentials of life like your accommodation, your feeding, your clothing, your transport to work, your utility bills, everything that you need, you're going on holiday, and everything you need to enjoy life is within this bread portion of your income. And then the seed part of your income is meant to be invested, is meant to be planted. Why your generosity is also part of it. We also have to be generous to other people, to the causes that we are passionate about in life. And so this, for me, this is my emphasis that we often give. We give in church for those who are Christians. We give to our families. We give to our loved ones. We give to our friends. We eat, but we don't put aside to plant, which will give us more of this whole thing later in the future. And so that would take us to money management. If you understand the concept of the seed and you are putting your seed aside, then you will. The next thing is, what do I do with that seed? You want to invest it because savings account is dead, and I'll probably explain that to us. Maybe I should quickly explain it. Savings account is dead. If you have money in savings account, it's time to go and remove it and put it into some other kind of account. The traditional savings account is dead. And let me just quickly explain that. Like I said, I will freestyle it a little bit. Um, Savings account is dead in the fact that going forward, for every let me put some figures. Let me put some numbers on our screen to help us understand what I'm trying to explain. So let me just open a notepad, put a notepad here, and then I'm going to bring this table in. Okay, so I will explain what this is. I will explain what this is. If you have money in savings account is totally dead. So if you have, and then let me bring in the next one so we could understand what I'm trying to explain. Okay, I hope you can still see my screen. I'm just going to reduce the space here. So this is more like a coaching, okay? Okay, so if your income is between zero income to 50,000 if this is the bracket of your income, or you can earn in interest in a year without paying tax is £1,000. Anything above £1,000, you start paying taxes on your savings account. And this, your bank, going forward, your bank will report any extra interest you make on your savings to HMRC. HMRC will adjust your tax code to collect this tax. So if even before, people earn interest on their savings account and they don't report it because they don't do self-assessment, and we've been getting away with it for a very long time. But going forward, all at the allowance you have, which is the maximum, is 1,000 interest in a year before you start paying taxes on it. And what does that mean? Which I will explain how you will get to that bracket. Let me put it down here. It means if you earn this amount, if you are within this tax bracket, the maximum you could have in your savings account is 21,000 at 4%, 4.7% interest rate before you start paying taxes. Anything above this, so if you are here, you earn between 0 and 50,200, and you have more than 21,000 in your savings account, you start paying taxes on it. Your tax code will be adjusted. If you earn between 50,000 and 125,000, meaning you are a higher rate taxpayer, anything you earn above £500, your tax code will be adjusted. You start paying taxes on your interest. That means you can't have more than 10,000 in your savings account before you start paying taxes. Okay, for those who are earning above this amount, 125,140, the 45% higher. People here have so many woes because when you cross 100,000, you start losing this 12,000 allowance. For every 2,000 you earn, above 100,000, you lose 1,000 of your 12,000 allowance. By the time you get to 25,000, you don't have any allowance again, and that is what is called the 60% tax trap. Any money you have earned above 100,000, you are paying 60% tax on that particular money you earn above 100K. And people who are also here, they have zero allowance. So if you're earning above 125,000, you can only put £1. Your allowance in your savings account is £1. Anything above £1, your bank will report it to HMRC for tax purposes, and you start paying taxes. And I could imagine how many of us will fall into that category. You start paying taxes, anything £1 above it. And what is the solution? The solution is that start moving your money to cash ISA. That's the only solution that you have right now where you don't have to pay tax. And if you are someone who is risk averse, you don't understand investing yet, that's okay. But cash ISA is a savings account, but with a tax wrapper around it, where you don't have to pay taxes on the interest earned and on your capital gains. Anything you gain within an ISA, you don't pay taxes on it. And so, but you have a maximum. You can only move maximum of 20K in a year into your ISA. But if you are someone, I know a lot of people who said, I know how to save. I don't understand investing, but I save a lot of money. If you're in that category, your money must be in one type of ISA or the other, or else you start paying taxes, as I've just explained. So that's just by the way. Okay, let's continue. So money management, which is the next fundamental thing we must understand when it comes to uh, uh, building wealth or becoming wealthy. Now, what's this all about? I've explained that.
I want to.
I've explained that. Okay. So, what's money management, and very essential. It's not about how much you earn. Building wealth is not about how big your income is. We heard about a lot of footballers in this country who have become uh, bankrupt. We had about a lot of basketball players in America, football players in America. We had about a lot of bankers. We had a lot of people who have touched money when they were actively working, and after that they became bankrupt and they don't have anything anymore. So it's not so much about how much you earn; it's about how much you are able to manage whatever resources is coming into your hands. And this is what normally these are Achilles heel. It's called lifestyle creep. that when you allow your lifestyle to go up in line with your income, then you are setting up yourself not to have any disposable income that you can use for investing. I said what each of us calls our necessary expenses will rise up to become equal to our income unless you protest to the contrary or unless you do something about it. That's a quote from the rich man in Babylon, a novel or book. It's a book I recommend that we read. To give us a good understanding of managing money, the fundamentals of managing money. And so when income comes in, there's a need for us to manage it very well. And the way I'm going to explain it is not this the 50-30-60 rule. Yeah, is good, is a rule of budgeting, is very good. But the way I'm going to explain it is what I've called giving purpose to your money. Giving purpose to your money. I recorded a video which I'm going to post on my YouTube in maybe in a week or two time. I recorded it maybe last week. I said I was talking about 4 ways not to get broke before the second week of the month. That was the title of that video. How not to get broke before the second week in the month, which I think is a common experience. That before by the third week of the month, you are expecting the salary for the month already. And one of the key thing in that video is what I'm going to explain to us right now is the fact that you must give purpose to your money. You must give purpose to your money. That's my own way of saying you must budget your money so that you don't think it's an esoteric kind of statement. To give purpose to your money is to budget your money. But I hate to use the word budget because when people hear the word budget, they think budget is for people who have a lot of money, or when you say budget, budget means a lifestyle of suffering and being frugal, and then I won't have the means of enjoying my life. But that is not what it's all about. It's about giving purpose to every dime that you earn. In our family, December of every month, we sit down and we give purpose to every money that we know will come in for us during the year. Extras could come in, but we know what the minimum would likely be, all things being equal. And so, before the beginning of the year, the whole year is already budgeted. So the whole year is already planned for. It means you know that this money when you come in, £5 out of this money coming in, you are meant to service my car by December, October, whatever you service your car on a yearly basis. These £10, you are meant for me to go on holiday because you are meant for my enjoyment. That's your purpose. So that's what it means to give purpose. This £20 when you come in at the beginning of the month, you are meant for my child's education, and so you are going to so place, and that is your purpose. And this particular amount, you are meant for me to wear good clothes and for me to go for dinner date with my wife. And so this is the place where you are going to. I'm giving you your purpose. This one you are meant to help other people. And so I've given this amount. This amount you are meant for you are my generosity. Your purpose is for generosity, and you are going to so account. And so you'll be there until I need you to give to somebody or to help somebody. This amount, that is the way you give purpose to your money. And I'll just quickly go through it. So this is the diagram to explain it. Like I said, I won't go through the slide one after the other like I would normally do. And so if you look at this diagram, what is it saying? The first thing is that you must have a plan. Forget about how you've been living currently, about how you've been spending money currently. Have a financial vision. Okay, I'll be expecting questions in the chat, or you can put up your hand to ask me a question if more people have joined us since we started. So if you didn't hear this, you can stop me anytime to ask questions. You can type it in the chat. You can type it anonymously, or if you want to speak, I can unmute you and you'll be able to ask that question verbally using the audio, using your mic. Okay, so the first thing you want to do is to have a vision. What are the things that you want to do that has to do with money that you need to pay for? Okay, what are those things? Make a list of them. For it could be medium term, it could be long term, it could be short term, it could be recurrent spending, like you keeping the lights on, keeping the heating on, and the rest of it. Have a vision, make a list of the things you want. How do you want to live on a monthly basis, yearly basis? What do you want the future to look like? Make the plan as your financial vision. And then and from it, you have a list of your needs, your wants, and everything that you might need. And then what you're now going to do is to go to your account. If you have not been doing this before, this is how to do it. You now go to your account to download your statement for the last 3 to 6 months and look at how you've been spending your money. Look at where the money has been going to. Are they in line with my list? So if they are in line with your list, you will see. If they are not, the ones that are not in line with your list, you also see. So I got something in the chat. What are the things we need to invest in that can give money so we don't continue to depend on salary? Yes, we will get them. And after this, we'll get there. So I'm laying foundation. That's what we're going to look. Well, that's what we'll look at after money management. That's what we'll go into. Good question. Thank you. And so we'll go in after this. Some people don't have money to invest because they need to understand the aspect of money management. And that is why we see it as one of the foundations. Some people don't recognize the power of the seed in their income, and that was why we treated that also first. Okay, I will get there very soon. Okay, so you match your spending to now, once you look at your past spending, match it to your list, your vision. If it doesn't match, a lot of them will match, but there'll be some things you'll be spending money on you think I shouldn't be spending money on again. Then you now need to tag your new vision to what? Your needs, your wants, your good memory, and your good future. And then you reallocate your finances, then you automate the process. Very important that you automate the process. And this is the allocation that I've come up with. 60% you must have. In most cases, we take over 60% of your income, where your rent, your mortgage is about 25% of your income. It shouldn't be more than that. If your rent or mortgage is more than 25% to 28% of your income, then you live in a place too big or too expensive for you. You need to look into that. So you allocate to what you could have, your good future, your good memory, what you enjoy. Some people say, I want to enjoy the now. Yes, you budget for your enjoyment and budget for the future. Don't forget to budget for the future. Okay, so move on from there. This is the 60, 20, the 60, the 50, 30, 20 rule of possible way to allocate your finances. We're going to go to multiple streams of income, which is one area that we want to spend the rest of the evening. And so multiple streams of income, what are the things that we can now put this money into after properly allocating them? So I didn't go into spreadsheet and the rest of them uh, because I want to dwell more on the other part. But what is important is that budget money either for your children education, for your retirement, or for you to, when you plan to retire early, or you want to have a choice as to when to work and not when to work. You need money to be able to sustain or finance that kind of intentions. And so there's a need for you to have within your budget an amount which you pay yourself. And so what do you do with that money when you have it? We know what to do with the rest, isn't it? The rest already have a label. We know what to do with the rest. But what you do with your savings and your investment, for those who already have money in the savings, traditional savings account, what do you do with it? Apart from putting it into your cash ISA. So let's look at that now. Okay, follow us on YouTube and Instagram. Some of these videos will be there. Some of the other videos that I've recorded in the past will also be there. What we just money management. I did it January this year. I did spend 2 hours talking about it. The video is there on YouTube. You can go read it. The handle is IBWFG on all social media: TikTok, Instagram, YouTube, Facebook, and yeah. Okay, so the first thing I'm going to talk about is cash flow quadrant, still emphasizing the flow of money. What does that mean? Cash flow quadrant is talking about the fact that all of us belong to one of these, or one or more of these quadrants. We have the employee quadrant, the self-employed quadrant, the business owner quadrant, and the investors quadrant. But what is this saying? It's that if you're an employee, your time equal to money. You have no leverage. Okay, when you own a job, somebody like myself who is self-employed, who is a self-employed contractor, I have my time equals to money, maybe a little bit more money, but I have no leverage because if I don't work, I don't get paid. And in fact, somebody who is an employee is probably better than myself because whether you go to work or not, you have your sick leave to claim, and then you still have your salary at the end of the month anyway. And for those who are self-employed or people who are sole trader, if they don't work, in most cases they don't make money. But again, you probably, if you are now a business owner and you've set up systems and structure, people are working for you, then more people equal to more money. Then you have leverage because you don't have to be there in order to make money. And then you now have someone who is an investor where money makes more money for you. What Robert Kiyosaki is saying in this cash flow quadrant is that wherever you are in this quadrant, you must have an investor's mentality. Let money from your business flow into other investments. As an employee, let your salary flow into the high quadrant. As a self-employed person, let your money also flow into the high quadrant. And that is where you have passive income and leverage. And so when you are sleeping, your money is making more money for you. Okay. Yeah, we understand. I think we all are familiar with this. Active way of making income, of making money is this. And the passive way of making income is when you have incomes from rental properties, from stocks, dividend and stocks, and then from royalty, from books, from music, from patents, from maybe videos on YouTube or on Instagram, or you're an Instagram influencer, or from affiliate marketing, reselling someone else's product, and then or any from online business that you put on autopilot. This is the place you want to be, working smart. Okay. The first thing here, which is active way of making money, is when you start a venture, when you start a business. To start a business, the only thing I will talk about here is that one, you must create value, you must do all of that. But the thing I want to say here is that for your business to become passive, to go from being active income to passive income, you must go into a business that is scalable. A business, when you're starting a side hustle, go into a side hustle that you can exist, that can still run without you being there, that can make money without you being there, or that someone else can do for you, even when you are not there. You want to build your side hustle to become that, so that it can become truly passive income for you. So that a lot of people who are side hustle have just got a second job, and it's taking so much from them. And how to choose a side hustle is what I've listed here. I won't go so much into that. A lot of things that can be done. So individuals need to understand the area they are going into. So how do you earn money? A good way to earn money passively, which is what I want to emphasize on tonight. One of it is real estate. Very common, you would say. But let me explain some of the advantages we have within real estate. And this is something that gives me passive income. At the beginning, it might not give you the kind of income, it might not replace your salary, but as time goes on, you begin to grow in that business, and that could give you a lot of passive income. So the advantages is the fact that you're able to leverage. What does it mean to leverage? It means you don't have to put the whole money down. The bank can loan you a particular amount of money to invest in real estate. If you're buying your personal house, we know with 5%, 10%, you can get it. But when it comes to commercial or buy to let, you need 25%, 30% to be able to buy. But the bank will be willing to give you 75% or 70%, whatever is left for you to complete that purchase. They will give that to you. And a good thing about real estate is capital appreciation. Capital appreciation. Uh, my personal example, I think maybe I have it here. So that's a personal example that I have here. When it comes to capital appreciation, over the years, people are looking for house prices to come down, and the current government is trying all their best to bring down the price of houses. But we know that the supply demand outstrips the supply, and so that is keeping the price. And people are waiting for the price to crash. I don't think it's crashing anytime soon. And so, if you want to get on the housing ladder, please do get it. Do get on it as soon as possible, because before you do it, in 5 years' time, in 10 years' time, you've gained about 40, 30, or 50%, even 100% on your investment into real estate. And again, if you have a rental in a rental house, it's going to give you cash flow. which is the name of the game. The name of the game is cash flow. Your real estate will cash flow for you. DD. Okay, do you have any course on okay, I didn't get okay on real estate. So the course I have is not totally focused on real estate. It will give you an introduction to real estate. Real estate has got so many components to it. And so the course I have on real estate, it will give you an introduction to real estate. There are almost 10 parts to real estate, and each of them is a course on its own. From you being an accidental landlord to you having the normal buy-to-let, commercial real estate, rent-to-rent, service accommodation, and a lot more, social housing, student accommodation. So when it comes to real estate, you want to decide which one do I want, then go for a focused training in that particular area. What I have on real estate is an introduction. So we have equity release. Yeah, physical is equity release is a very good aspect of real estate that you can have one property, two properties, and before you know it, in the space of a decade or 2 decades, you can end up having up to 10 without you putting money from your pocket again because you're able to do equity release from your current property. And I'll just quickly explain what that is, which is something that so what does equity release really mean? It means that let's assume you bought a house for 100,000 and then you put down a 10% deposit, a 10% deposit, and you took a loan of of 90K, which is 90% loan. Let's assume in years to come, let's say I will use round figures. Let's assume in another 5 years or so, the house is now worth 150. So it means your equity has increased to 10, okay, plus the 50 here, which is now your equity in the house is now 60,000. But if you want to do equity release, at this point, if the house, let's assume the house is your personal house, you want to do equity release, it means you go and remortgage. When you remortgage this house, what you're going to do is that the new lender will value the house to be 150,000. So they are willing to give you 150,000 for your house. So from that 150, you'll be required to bring 15,000, which is the new 10,000, the new 10% deposit on the house. When you deposit 15,000, then again you will pay off your old lender 90,000 to pay off that loan. That make it 105,000. So the total here is 105,000. But the house is now worth 150,000. So you get equity release of 45,000 will be your equity release. This will be given to you cash and you don't pay taxes on it. And so you can take this money and go and invest that money. That is a simple explanation of equity release. That over the years, equity will build in your real estate, in your either your personal real estate or your buy-to-let real estate. And from there, you release equity, and this can be used to buy another property. By the time you have two property, in another 5 or whatever years, you can plus rent, and from equity release, you can put it together and you to buy the third house, and that could snowball into something very big. It's something that I've done also over the years. It's a physical asset. There's housing shortage, as I've said before, and it's also diversification because you look at other aspects of investing today, and this is just one of them. It's a store of value. It means you're protected against inflation. Your deposit is within the bricks and mortar of that house. You don't lose it. And then an example of how we turn like 10,500 to more than 500,000. Okay, so a few examples here. Like I said, each of these is a training in itself, which I won't bother going into them. You know what rent to rent is when you rent from a landlord with an agreement to rent to other people. And that could become a service accommodation which is what you see on Airbnb or what you see on bookings.com, or you could become an HMO. This is where you have multiple people living in the same house and you get paid per month. Here you get paid per night. Here you get paid per month, per room, per room per month. Here is per room per night. And that's how that is. And then we have commercial real estate, which also has a lot of tax advantage. If you're interested in any one of these, I do not offer in-depth training on individual of them. Okay, for my personal example, when it comes to real estate, um, is for just this is just an example of two of our houses. Started 2010 with a deposit of 10,500. Did an equity release, bought another one, which is now this now over like 150, 170 in value thereabout. Sorry, about 380 in value thereabout. So from this 10,000, you've been able to generate asset worth about 0.5 million or 0.6 million, 0.55 million thereabout from 10,000 that was put aside about 15 years ago. And so before you know it, I said, don't wait until you can afford a mansion. This house wasn't a mansion, it was a three-bed terrace, end of terrace, that we lived in for 2 years. And then we move out of it, turn it to a buy to let after 2 years, making us an accidental landlord, which is the first thing I put in here. When you do that, you become an accidental landlord. And then your mortgage provider might allow you to stay on 10% or no up to 30%, and so also and rent out the house to somebody who will keep paying your mortgage, as I would say. And so you get on it, and later you can always move on from that house to another house. But you don't want to do this too much because there are new tax implications that might affect you when you have so many houses on your personal name. That's, like I put here, more details is in other training for real estate training that we do have as part of our masterclass. Okay. Um, yeah, so the next one is passive income in stock and shares. So my training is mainly focused on stock and shares. If you come for that training that I have, I'm going to focus days teaching you on stock and shares. Not as if we don't have, we got quite a lot in real estate, but I think stock and share investment is something that everybody can participate in. So with £1, you can actually start investing, which I think is something that every one of us can participate in to make our money work for us. Okay, and that's what something every one of us can participate in to make our money work for us. So let's dive into that also. So I said this is not day trading. I do have some cryptocurrency. It's about £700, but if you consider that versus the asset that I have, you will know that it is nothing compared to total assets. So why don't I do day trading? 70% of people who day trade lose their money. Okay, and we know cryptocurrency is up today, is down tomorrow. The only currency, if you really, really desperate and you think you don't want to miss out on what is going on in the economy, is Bitcoin. Anything outside of Bitcoin, don't touch. Don't I would say don't touch. Why am I saying Bitcoin? Is because there are a lot of institutional investors who have put billions and billions into Bitcoin. Nations are buying Bitcoins, big companies are buying Bitcoin. And so even though I don't train on it, I don't recommend it as an investment. But if you don't want to miss out, maybe if you are putting away 1,000 in a month into investment, maybe you put £50 out of it into crypto. That's what I won't say more than that when it comes to crypto and trading. Now, where else do you put your money? You want to become shareholders of reputable companies. I saw an headline which I put on my actually put on my status today, and this is what that headline said. I'm going to drag it into the screen for us to see. And how do you become how do you get a slice of this? It said during 2024, UK blue chip shares paid out 78.5 billion in ordinary shares. So they are preferential shareholders. This is the ordinary shares, the ones that those of us who are retail investors that will buy. 78 billion, according to AJ Bell, which is one of the investment platforms that I will talk about today. Said that worked out to be a 41.5 billion a week on average, a number unmatched anywhere else in the world. Okay, and I have got a UK dividend portfolio that I built. So you want to copy my portfolio, yeah, that will be a chance to do that in November, when I will I'll be talking about this. So I get a slice of this 78 billion. At least a bit of it is coming to me almost on a weekly basis, and so you need to have a share of what is going on. And UK is the best place to buy dividend, or if you want to invest for income. So when you're investing, is that for growth or for income? So if you're investing for income, you want to buy some UK dividend shares. UK is the best place where you can get dividend. Is there any way to identify those blue chip companies? Yes, there are ways to identify them. The easiest way is to look at FTSE 100 companies, which I will talk about as we go on now. The best way is to look at FTSE 100 companies. Okay, investing to become a shareholder. So when you become a shareholder, what do? You benefit from the success of the business. You also have a responsibility to vote. You get email I get email all the time to vote on Tesla, vote on Microsoft, vote on Lloyd's Bank, for what is going on there for me to participate. So you have you have ownership of a little slice of that company. You are benefit if they do pay dividend. You are benefit of dividend. You are benefit of voting as per what is going on with the company. You also have what is called capital appreciation on your money. And then, like I said, you can connect to this now from your phone. It used to be in those days that you have to call somebody to help you buy, a stockbroker to help you buy this or help you buy that, but not anymore. With an app on your phone, you can connect to all the stock exchange in the world, and you can begin to buy, you can begin to invest in companies. Financial instruments you can buy when it comes to stock exchange is to buy individual stocks, mutual funds, trust funds, ETFs, index trackers, bonds, and derivatives, features, indices, or sorry, binary derivatives, features, and currencies. I do not recommend that you trade them. That is why I've canceled them out. They're available on the apps you are going to download and install, but I discourage people doing this because it's trading, is speculative. You lose your money doing that. Warren Buffett says something that the first rule of investing is protect your capital. The second rule of investing is remember the first rule, which means you must by all means protect your capital. And that is what I'm for. As much as I want the gains, I also don't want to lose my hard-earned money. Okay, these are the things you can invest in. And then why the stock market? A lot of the money you contribute at work for your pension ends up in the stock market. Okay, there are over $60 trillion in pension funds that are already in the stock market. America has the biggest market of all in all the world, with a market cap of 45 trillion in the stock. So a lot of companies that have invested in, a lot of them are in America, and that is for growth, while UK is for income. Okay, and the entry level, like I've said, is with £1 you can start investing. So let's first of all, before I go into real life examples, let's do a simulation using a compound interest calculator. So I'm going to open that up, and I've given some examples here, and I've said that if you have a child who is age 0, and what you start with doesn't really matter, and you put away £200 for that child on a monthly basis at a return of about 10% compound interest for 18 years, that child will have 126,000 by the time they are going to college. And that means they can do what? They can pay, they can go to school tuition free. They can have the deposit for their first house from that money. It means you set them up for life. And if you're an adult and then you start at age 30, for instance, you put away £300 on a monthly basis, you're expecting a return of 10% on your investment, compounding. By the time you are 60, you have over almost 700,000 you will have in that pension fund fund or in that ISA or SIP account, which is more than ×2 of the average pension in the UK. And so whatever your age is, that's also something you can do to achieve. So let me simulate. I think that this is a screenshot. I think yeah. Let me go to the live. Let me go to the internet. So that first of all was saying was I put 1,000, but you can actually use 200. You start with 200 and you keep putting 200. You're looking at just 10%. I use the word just. I'll tell you the reason why I use just. For the first 18 years of the life of that child, you're going to get to 120, which is you put in 43K, but you earn interest and capital appreciation of 77,000 is what has been added to that particular to the money. So you can imagine how good that is. And some of us, our children are already teenagers. It's not too late. Okay, even if you do it for 5 years, 5 years is something. If you do it for 10 years, it is something. If you can't do that, if you do 100, if you do £100, it is something. I have people who do 50 pounds on a monthly basis. That's something. If a child is 18 and it's got 60,000 waiting for their school fee or for their first house, it is something. If it is 50, if it's £50, it's also something, okay? Because that is what you can afford at that time. And 30K is also something. It will go a long way. And if you don't put it away, you spend it anyway. That's one funny thing with money, that if you don't put money away, you don't find it in the account. That's something I do is when I have one money in the account, that money is going out of that account immediately. If I know it's not meant to be spent. If you leave money in your account for extra 1 week, before you know it, that money is gone. You don't know what you spent it on. You don't humanize. You don't play lotto. You don't do anything, but that money is gone, and you don't even know where the money has gone to. That's the nature of money. So the quicker you put it away, the better. For me, the very first day of the month, money is going to where they're supposed to go to out of my account. They are all going to where they're supposed to go to. Okay, the money is going to where it's supposed to go to before the beginning of the month. Sorry, my phone is ringing. I need to turn that off. So apologies for that. Okay, so I'm going to simulate more. Let's assume you are an adult and you are able to put in, let's say, 350 pounds away, and then you're able to do it consistently for, let's say, 30 years, and you do that on a monthly basis. And these are things you could automate. What are you going to? Are you going to have 700, about 780, almost 798,000, almost 800,000 in your account within that period? And this is something you can do passively. It doesn't take your time at all. In my training, what I do, you automate. I call it smart investing. You automate your investment. The money going into your platform is automated. Platform automatically invests the money for you, and you don't actually need to do anything for years to come. Just forget that money is leaving your account, is going, and it's going there. It's being invested for you. It's growing for you. When you open your account in years to come, you have thousands of pounds. Let me show us a small example of an account that was opened last year. I don't know which account this is going to log into. Okay, look at this account was opened last year. You can see the rate of return. The rate of return has been 37%. Okay, and that is called rate of return, which is, so rate of return, we factor in when the money came in. So money that came in yesterday will not have the same weight as money that came in 12 months ago, if you get what I mean. And so the rate of return has been 37% on this particular portfolio started last year. And you can't get that in any savings account. So let's continue. So I'm using 10% in this case. So let's see, this will give you this. And let's simulate it further. Let's assume when you are now 60, you start to retire at 60, but you retire with 790. You start with 790K in your account, and at this point, let's assume you start withdrawing money until you turn to age 100. That's another 40 years. At this point, you don't deposit anymore. What you do is that you withdraw. Let's assume you are withdrawing a reasonable amount, which maybe 5,000 on a monthly basis from that. Let's see what that is going to give us. Okay, see what this is saying is that when you start with 700,000, that money will never finish. Why? You will have earned a total interest of an additional 12 million within that 40-year period when you are in retirement. All you spent is 2.4 million within those period of time. If you want to increase that, you can increase that. Why? Why is that the case? It's because your rate of interest is more than your rate of withdrawal. You're only spending your interest. When you get to retirement, all you are spending is your interest, and your capital is still working for you. You are not even spending, at some point, you are not even spending half of your interest anymore. It means you can decide to even go as high as, as you get older, you can actually increase how much you take out of your retirement fund, because what, the capital is still working for you. And then at age 100, you still have 10 million in that account. This is possibility. It's mathematics I've done for us, but let's look at it in real life. Let's look at it in real life. Okay, so I've got here. So if you're going to put in the chat, let's assume I give us or someone should give us £5,000 today. Which company will you likely buy? Without doing any research, you just close your eyes. You think, okay, I want to start investing, and I have this 5,000 with me. Without doing any research, put in the chat which company will you put the money into. Anyone can put any money, any company in the chat at all. I think I have a few on my screen, but if you have any other one that has ever crossed your mind, that if I have money, I'm going to invest. I'm going to invest in this. Someone said he would put the money in Meta. Okay. Anyone else? Does anyone else have where they will put that money? So let's go look at what Meta is doing. Someone said Meta. So this website will help us. Is a calculator that will help you to know what Meta platform, which is the owner of Facebook and the owner of Instagram. Someone said I'm going to put it in blockchain. Someone said Netflix. Okay, so let's look at what that 5,000 will have been. Let's assume now here, we're going to assume that you invested that 5,000 10 years ago. That's 2015, October 16, 2015 to October 16, 2025. Let's see what 5,000 will have given you. Let's assume you put it in the company that you mentioned. That 5,000 will have become 37,000 without you lifting a finger. All you've done is you put the money away. What is the average return on a yearly basis? It will have given you 22% on a yearly basis on your money. And you can't get this anywhere when it comes to you putting money into savings account. You can see what that return is. Someone else says, I'm going to put the money into Tesla. Let's see what that will have given. Let's see what that will give you. So Tesla, we are giving you 146,000. 10, if you put, that will have been an average of 40% return on a yearly basis. That's what Tesla will have given you. You could imagine you putting 5,000 away 10 years ago, and you just open your phone today and you are seeing 145,000 in that account. That is phenomenal, isn't it? So let's look at another one that we have. So blockchain, for blockchain, we need to go and look for example, maybe Bitcoin. Let me see if there's Bitcoin here or BTC. Maybe I'm not sure this is tracking BTC. Okay, Bitcoin Treasury. No, that's not it. If you have a specific one, we can look for a specific one. So someone said Netflix. So if you put it into Netflix, what would Netflix are giving you? Netflix are giving you 60,000 today. So you can say that was 10 years ago. Okay. But let me show you what has happened this year, okay, with some of these companies. Let's look at Meta platform in the last 1 year. Will give you 23%. You can see it's not far from the average. In the last 5 years, will give you 166%. If you divide that by 5, okay, it's more than 25% on year in, year out. Let's look at Netflix Inc. So this is google.com, okay? Google Finance. Netflix will giving you, in the last 1 year, will giving you 68%. The last 5 years, will give you 122%, which is a lot more than 20% on a yearly basis. So I'm not saying buy Meta or buy Tesla or buy anything, but I'm just showing you that as it was 10 years ago, so it still is there are still companies that will give you, despite all the ups and downs, like it give you 93% in the last 1 year. The last 5 years, like giving you 191%. Okay, and these are companies that you just pick from the blues without even having to do any research. Talk less of when you do research and you buy a company like this that you have down here, or any of these companies that have done over 1,000%. Okay, and I have some of them in my portfolio. Okay, so what am I saying is that another way to invest is through the stock market, and the 10% that I used earlier was conservative. And let's go into where a lot of people will say stock market can return more than 8 to 10%. Yes, the reason why we say that is because we look at this particular index. So S&P 500 is an index. NASDAQ is an index. Somebody asked for blue chip. So I said I was going to talk about it. So blue chip in the UK is FTSE. So if you look at here, you see FTSE 100. Those are the blue chip company in the UK, 100 of them. Come to America, these are 500 of them. And there's also NASDAQ 100. So, and there's Dow Jones 30. The 30 of them are industrial companies like Caterpillar, manufacturing companies, they are here. While 500 biggest company in America is here, then you can see NASDAQ 100, you can see FTSE 100, okay? And those are the ones, because they are averages, so those are the ones you use to measure the return in the market. And that is why the people will say you can only get 10%. No, you can get percent when you only bought this particular index. So S&P 500 in the last since 1928, almost 100 years, has returned an average of 11.8%. That's the annual mean return has been 11.8%. And the last 15 years, it has returned 15.5% on the average per year. While NASDAQ, since 1986, it has returned 18.7%, and in the last 15 years, 22.7% on a yearly basis. What am I trying to say is that stock market is not as bad as people talk about it. You have minimized your screen. Can you still see my screen, please? The screen you can see now should be a slide where you have the S&P 500 returns and the NASDAQ return is what I now have on my screen. Okay, and so we can see the return. Even though when you look at news, they will tell you, oh, market is crashing, there's war here, there's problem here, there's problem there. But in the last 15 years, market has only been negative twice in the last 15 years. So some people are making this money on a daily basis. Yeah, the ups and down is there because it will not always go on a straight line, as you can see on my screen. This is S&P 500. It won't go on a straight line. And let me show us a real life example of that graph. That graph is a little bit outdated. Let's go to finance. Yahoo Finance will give us a better graph than what this is S&P 500. Let me put maximum. So that is that chart here. So that is that same chart. If I go back to my slide, so this coming down here is this place. That's 20. No, sorry, coming down there is actually 20 when Trump. Let me see the year. Sorry, let me look at the year. So the year here will be 2022. That was during the inflation of 2022, which is 2025, which is here 2022. And so the graph is outdated. This is the current look of the graph. So the market is at all-time high. Did it go? It didn't go up. Did it go up on a straight line? No, it did not go up on a straight line. There are ups and down. In 2000, there was dot-com bubble. In 2008, 2009, there was the banking crisis. In 2020, there was coronavirus. It came down sharply that same year. It recovered back again. In 2022, there was the inflation when energy prices went off the roof. In early this year, Trump came in and said he was going to put tariff on all the nations of the world. It came down, but this is where the market is today. So there could be a lot of things happening in the economy. That is what is being amplified. But people are making money. The billionaires are getting richer, okay? And people who choose to participate in the stock market are also getting richer. So now let's move on. So I think that's a more current chart, maybe last month or so. So I've explained this point, what happened where I've circled, but you can see that it's still uptrend. So I said doing nothing or procrastinating is riskier than making informed decision. What we need to do is to understand. Don't put your money in what you don't understand, but seek understanding. Seek to seek knowledge. When you understand it, you significantly reduce your risk when you understand what you are doing, okay, than you not doing anything before, because you are held back by fear of what might happen to your capital. Okay, now accounts that we can open. So the accounts we can open, one of them is the junior ISA. We probably, you must have heard that before. Junior ISA, and like I said, if you don't have a cash ISA, open the cash ISA. It's better you save in your cash ISA than you save in your normal savings account. That was how I started. For those who joined late, the current, the normal, what do you call it? Savings account is dead. You start paying taxes on your interest. Go open a cash ISA to start with, and then you can now start looking into stock and shares. Okay, so the junior ISA is a stock and shares kind of ISA. Parents can put in, and parents and grandparents and people can put in money for that child up to a maximum of 9,000 in a yearly basis. It is tax free. When the child turns 18, they will take control of the account without your permission. It will transfer to them because the account will be in their name. So it's good that you train your child in the area of investing, get them involved in investing as they grow up, so that they can continue to uphold that tradition when they inherit the account from you at the age of 18. These are platforms where you can open this account today. You can start with as little as maybe 25 pounds, actually, no matter, with as little as any amount you can start. And then the next account I'm going to talk about is, any question there? No. Is the lifetime ISA. Again, I tell people, if you are not up to 40 yet, please go and open a lifetime ISA. Even if you don't know what to do with it, open it and put £1 into it. When you understand it, then you can now do something about it. But if you're not up to 40 yet, open a lifetime ISA first, either cash lifetime ISA or the stock and share lifetime ISA. Now, let me quickly do, for those of us who are here now, why am I saying that? Now, this account, there are two major benefits for this account. The first one is that you can buy your first house with it. Okay, that is no more news to a lot of people. That any money you put into that account, government will top it up with 25% for you, and that 25% is meant for you. They won't collect it back if you buy your first house with it. So let's assume you want to save towards your house in the next 3 years, or in the next 4 years, and you're able to put aside 4,000 on a yearly basis for the next, let's say, 4 years. It means government will give you 1,000 extra on top of it for that period of time. So you only need to put in, let's say, 16,000, and before you know it, your money is almost it's already 20,000, because government will give you 25% of any amount you put. If you put £100, you get £25 on top of it. If you put £1,000, you get 250 pounds on top of it. Whatever you put in, you get 25% on top of it. Now the caveat is this: if you don't buy after you bought your house, you can continue with that account to become your retirement account. Now, if you don't buy your first out with it, then it must be your retirement account. And you can't touch it until you turn age 60. And the government will keep adding money until you turn 50. They keep adding money to it until you turn 50. Okay, from age 18 to age 50, government will be adding 25% on for any amount you put into it. The platform on which you have the place will also give you interest, or the stock you invested into it will also give you return on top of what the government has already given to you. And the good thing is that when you now retire at 60, you don't pay taxes, which is very good. Now, your workplace pension, when you retire, you are going to pay taxes. Your state pension, when they start giving it to you, if it's above 12,000, you are going to pay taxes. But when you have your ISA as your pension, indirectly, you don't pay taxes when you retire. You're going to get away with this money you've invested, government money you have been investing with. Now, if you want to withdraw the money before 60, they collect 25% tax on it. If you withdraw the money, if you don't buy your house with it, and then you don't wait until you are 60, they will tax you at 25%. Okay, that is a penalty for touching it, for not using it for the purposes for which government wanted you to use it for. And so that penalty is a deterrent for you not to touch it, which makes it very good for what do you call it, for retirement. Okay, let's move on. So something big can come out of something very small. Yes, over time investment will grow. There is something called a SIP. I would rather you open a junior SIP. You can open it for a child from the age of 0 to age of 18. I would rather you open a junior ISA for your children than open a junior SIP. Even though there are advantages there are advantages with one advantage with junior SIP is that government will give you 25% of whatever you put into the account. Because you use your after-tax money to invest into pension for your children, government will return your tax back to you. Okay, anybody who opens a SIP gets get an amount back into it. Especially if you are age 0 to age 17, you get the 20% top up. So your parent can put in 2,880 per year, but with the government top up, it becomes 360, 3,600 in a year. You can't withdraw from it until you are 55, and that's the reason why I'm saying I prefer the junior ISA, which is also tax-free. And this later you pay tax on this when the child becomes an adult and they are retiring. Okay, another account you can open is now the ISA account, which is more like the adult ISA. So you have the junior ISA, then you have the adult ISA, which is the normal ISA account that if you're over 18 and above, you can open that. And across all your ISA, you can put in £20,000 in a year. And the profit is tax-free. The capital gain also tax-free, just like the savings account. And you can start all of these accounts with as little as £1, actually, £1, £2, or £3. And if you have money like 10,000, 15,000, I've seen people who have that much who, and we've guided on how to invest it into their stock and share ISA. If you have bulk money you want to invest, that is also fine. If you want to do a monthly thing or once in 2 months, then it's also something that you can do. Okay. So there are billionaires in the UK who are ISA billionaires and they don't have to pay taxes. Okay, number 5 is your SIPP or your SIP, or what is called a self-invested personal pension. So what I encourage people to do is that leave your pension where they are. If you have an NHS pension, leave it where it is. Okay, if you have a workplace pension, leave it where that pension is. Let the professional manage it. But in addition to that, you can also set up a private pension which you manage yourself. I can bet you when you become confident in what you are doing, you might say, okay, give me my money, I'm going to manage everything myself, which is what I am doing. But I don't encourage people to do it at the beginning because you need to be very confident that you are, over the years, I saw that I was doing a lot better than than all the professionals because fees are taking away all my pension growth. I decided to start managing it myself, and I haven't, and there's no regret on that so far. And so you can set up a SIP. Any money you put into your SIP, you get back, can get back up to 45% of whatever you put into your SIP, depending on your tax brackets, from 25%, 40%, or 45%. The first 25% is added back to your account automatically. You don't need to request for it. Your platform will claim it from you from HMRC, and it's added back to your account. But anything above the first 25%, if you earn 50,200 and above, you need to claim the remaining 20% or 25%. You need to claim it back through your self-assessment. That will be given to you as tax relief on your self-assessment, and you claim that back, and then that represents your pension. You can't touch this money until you turn 55, and by 2028 it's going to 57. So you can't touch this money until you are 57. And the reason why I said if you are below 40, last time might be better for you is that what is the difference between 57 and 60? 3-year difference. Here you pay taxes with your SIP. In LISA, you don't pay taxes. A 3-year difference, and you don't pay taxes for the rest of your life. So that makes LISA or lifetime ISA a winner for me as a person. it makes it a winner for me as a person. And you can't touch it because there's that deterrent of you paying 25% taxes if you touch it, just like you can't touch your pension. So that's giving you a kind of a guide, call it a guide rail for you not to touch it, a defense for you not to touch it. Okay, those are the accounts you can open. The best time to plant a tree was 20 years ago, and the second best time is now. As you have seen that all those companies that did well in the last 10 years, some of them are still doing well right now. And so if you've not done anything up to now, you can still start now. I didn't start really investing on the age of to the age of almost 40. Okay, and over the years, um, don't try to imagine my age. And over the years, I've been able to do a lot. Okay, anything else in the yeah, no. Okay, now opening your account, I want us to take action, and if I want us to take action even right now or even by tomorrow, or I want I'll give you some of the platform on which you can go and open your account right now, and I will tell you what you can buy even now, uh, at least before you now have more knowledge about it. So this is the summary of what I just said, the accounts. Want to take screenshots, you can see the video on YouTube later, or you can take it now if you're very quick. That's the summary. Okay, how can you, which platform do you use? These are the platforms that you can use in the UK. The cheapest of them is Trading 212. So let me give that away for us free. Well, the best and the cheapest of them is Trading 212. And when I say is the cheapest for ISA, is for either for cash ISA, want to open a savings account, cash ISA, Trading 212 is the go-to place for me. If you want to open a stock and share ISA, Trading 212 is also the best. And next to that is free trade. And next to that is I would say interactive investor. Okay, the ones with double star on them are the ones where you can open a lifetime ISA. They offer a lifetime ISA. The ones with star. A lot of other ones, a lot of the remaining ones, they don't really offer lifetime ISA. Okay. So, and for those who might be joining from Nigeria, you have a family in Nigeria, you want to encourage them to start investing, which I think everybody should take responsibility, and you can reduce your black tax, is that, these are platforms through which people can invest in Nigeria. These are new generation startups, fintech, and they allow you to buy shares in America. You can own shares in dollars or in foreign denominated accounts. They have that. But if you want the traditional ones also, where you can buy mutual funds and Nigerian stocks, you can go with any of these. I use one, two, three of them in Nigeria. I think we actively use this. And I think it's more used by my wife more than myself. This particular one at the top, but I've used these other two in the past. Okay, so that is that. Now, going back to the accounts that you can open. So I've shown us here the best you can open for ISA. This is the best for ISA plus SIP. You want to open them together. This is the best. And then because these ones there are no charges. For here you pay charges. But this is free, and this is free. But for children ISAs, HL is the best for children ISA. Why did I say that? If you go on their website, you see that it's zero charges when you are investing HL. Zero charges when you are investing for children, investing junior stock and share ISA. If you look at their charges, you can see the charges is free to buy funds, buy UK shares, overseas shares, buy trust fund, ETFs, buy government bond. Government bond is what is called gilts. These are government bonds, and we have corporate bonds. To buy all of them is free on HL for children. It's expensive for adult, but it's free for children. Okay, and so they are the best for your junior ISA. Okay. Okay, so ask me questions if you have any. Now, so if you want to open, I want to start now, what can you buy? Let me go back. I'm going to give us one thing that we can do and do immediately. There's something called S&P 500. So for those who want to start investing, you want to probably start investing with you want to buy an index. So S&P 500 is a good one to buy. And here, let me search for it here. If you use trading 212, all you need to do is S&P 500. Okay, and any of these is what you can buy. Show that I have this and I have this. So that's why you have the blue tick on it. So any of these, actually the accumulative one, any of this is what you can buy to start investing tonight. And I'm going to give us one more. I'm going to give you NASDAQ 100, and any of this is also what any of these NASDAQ, and this one is in the EQQQ, it's in the UK. You can buy that. That is top 100 technology company in America. It's one of the best index you can buy out there. You can see in my slide that one that's the one that's returned over this one. Is those two are just those two I gave us now are the ones. Sorry for scrolling that quickly. Are the ones here. That's the one here, 15% in the last five years, and this other one, sorry, 15% in the last uh 15 years and 22% on a yearly basis from the for this particular one. These are the two I've just given to us, which you can start investing. But if you now want to understand how to go for that, how to analyze a company and know which company that can give you more return than this, then you need more education on how to look at financials, on how to analyze company, and how to know what you want to buy. So let's move on as we beginning to wrap up tonight. Um, sorry for no, it's not good. It's not good for the eyes, isn't it? Sorry for that scrolling. So how do you become successful as an investor? Okay, I've given some tips here. Become consistent, diversify, do your research, have a conviction, be patient. So investing is not get rich quick scheme. Okay, it's not getting rich quick. It's you being patient and watching your seed grow, bringing in harvest for you. Okay, it's you need to also understand risk management and don't follow the crowd on the internet, please. Uh, know what you are doing and make decisions yourself, and then do not get greedy. Do not get greedy. Don't say, ah man, this company has done 100%. I'm going to withdraw all my money and just put in this company. No, you need to be well diversified. Okay, so what have we looked at today? In conclusion, I've talked so much about seed building wealth is like agriculture. You cannot plant a seed today and expect to eat bread from it tonight. It's got to grow, have the blade, have the weed, the flower, and then you have the bread. So it's investing is a process. Give it time, let it grow, be patient. But it will come to a time when the rule when the return becomes astronomical, that you'll be wondering, you just can't even really control it anymore, because the rate of return on what you now have is just happening at a pace that is beyond you, and you don't have to do anything. That's the good thing about what I teach, what I teach in my master class. You automate everything. You spend less than 5 minutes in a month. And in fact, if you don't want to spend any time on it in a month, you don't have to. The only time you need to spend time on it is to check whether your automation is working fine. 2 or 3 minutes in a month, and that's all you need to do. Everything is automated for you, and you're in control of everything. So we talk about the fact that you need to educate yourself. We didn't talk so much about increasing your capacity to earn, but here is saying that keep moving, keep improving yourself. We talked about the need for us to be debt free. Don't give your income to credit card company, to low company. The more of your income you have, the more power you have to build wealth. And then we talk about you controlling, giving purpose to your money. Let every money know what they are going to do before you hand them. We talk about, and that has to do with delayed gratification. We talk about paying yourself first. It means you are allocating money into your investment account. Be consistent, be strategic, and then don't compare yourself with other people. Don't follow the crowd. Let God lead and trust God. And then, of course, enjoy yourself while you are doing all of these things. Like I said, when you give purpose to your money, that money that are meant for you to enjoy yourself, and then make sure the money gets there. Okay, that is what I will talk about today. I know there's so many things to talk about here. The tax relief I will talk about here. Let me quickly give us something on tax relief, and that is giving to charity. So when you give to charity, uh, there is benefit when you give to charity. Go and you can claim back up to 4 years. Now let me use the tax bracket to explain giving to charity. Now, when you give to charity, there's something called gift aid. So if you not claim your gift, all the offerings, if you're a Christian, all the offerings you've been given in church, all the tithes you've been paying in church, you are meant to get a tax relief on them. All the taxes you paid before paying that money, you are meant to get it. So, but there are two ways to it. So let me put a break here. So if you earn between 0 and 50,000, you can't claim a relief on your giving or your donation to charity. Now, your charity can claim back this 25%. It turned out to be 25% when they calculate it. But because people who are on 20% tax bracket, your charity can claim back 25% on all the money you have given to as offering or as tithe or as donation, as for special project. Your charity can claim back 20% if you sign the gift aid form. It doesn't affect you in any way, especially if you have paid enough taxes. So your giving cannot be more than times four of the tax that you have paid. If it's more than times four of the tax you have paid, then you might be owing the government money. So if your giving is not it's less than times four of the tax that you have paid, then your charity can claim back 25% of the amount you have given. But now for those who earn above 52,000, you can go back to HMRC and claim back another 20% of all the money you give to charity in the last 4 years. And that could be thousands of pounds. You can claim that back as your tax relief. That's one tax relief a lot of people they are not aware of. Or they are there and they don't know how to go and they don't know how to give back. Just talk to your accountant or call HMRC. If the money is not more than 5,000 that you want to collect back, you can do that over the phone with HMRC. But if it's a big amount, then you need to go through your accountant to help you correct your past tax. Especially if you have been doing self-assessment, they will correct your self-assessment and then they will claim that money back for you. That is one tax relief that you can claim back from the government. Okay, so you might want to ask me, how can I understand this better? How can I become an investor? How can I buy some of this individual company that can give me more than that 10% or 15%? Then, like I said, I'm having a class on the 15th of November, and this is a paid class. It's not free. But how much do you pay? You pay £150 is what you pay. But what will this give you? This is going to give you about 13 to 12 hours of training, one-to-one talking like this, almost 12 hours of training over a period of 1.5 weeks. So we're going to do a Saturday training, which will be a 5 hours training on a Saturday, the 15th of November. We're going to sit together face to face this way and talk, and I will explain how do you know a profitable company that can give you 30, 40, 100% in a year. Okay. And then we now go from there into mentoring. The following week, another 2 hours we spend in the evening on Tuesday. The next we spend another 2 hours, making it like 9 hours. We don't finish, spend another 2 hours, until we all have our portfolio established. And then in that class, I will be sharing with you my own portfolio, my growth portfolio, which is majorly American company and some UK companies that are returning very high percentage for me. That is one. And two, I'll be sharing with you my UK dividend portfolio, my share of that 1.5 billion per week. How am I getting my own share out of it through dividend? I will also share with you my dividend portfolio, my growth portfolio, and then we also do introduction into go a little bit further into real estate investing. But majority of the time we spend on you establishing an automated stock investing platform that once you start, all you need to do is just a standing order and you forget about it. And in 2, 3, 4 years, you can go open that account. I can assure you, all things being equal, if you don't have another coronavirus. And in fact, coronavirus didn't do too much damage because the market recovered the same year. Then we had the ripple effect 2002 when inflation came in because there was bottleneck in supply chain and there was too much money in the economy that led to inflation in 2022. And we can see that everything has recovered now. So you have almost 100-year history on your side. Like I said, S&P 500, which is the average of the market, the last 97 years has returned an average of 11.5% on a yearly basis. That is that gives us confidence, isn't it? That if you're a long-term player in the market, you will average out a very good percentage in what you invest in. So if you are interested in this, if you can DM me for me to explain more to you, and if you think you understand and you want to go, you want to take action on that, just go to my website, and then when you get there, where you registered for this particular training, click on the 250K challenge or click on the advanced class, and that will give you the 15th of November. If you click on that, you can actually pay using PayPal, which is you can pay on Zoom, and Zoom allows you to use PayPal to pay. Or if you want, you can transfer money into my Monzo account and send me your email and your phone number and your full name, and then I can register you manually. I can register you manually for that training. And the 50K challenge, let me quickly explain that to us. This is the 250K challenge is you picking a target. So I'm the coach, you pick a target. You say, I want to achieve 50K in the next 10 years. I want to achieve 100K in the next 5 years. I want to achieve 250K in the next 10 years. Whatever your target, you pick it, and I will tell you what you need to do to achieve that target. Okay, how long it might take you, how much commitment you need to invest on a monthly basis, what are the kind of stock you should invest it into. Okay, that would depend on the length of time. I'll be able to guide you on the type of category of stocks or more instrument to invest that money into for you to achieve whatever challenge you have picked for yourself. So it doesn't have to be 250K. If it's 100K, if it's 70K, if it's okay, I want to buy a house in the next 7 years, and this is what I'm targeting. Whatever is your target, then I will be there to guide you to achieve that target. And that is happening on the 15th of November. Okay, I will keep quiet there. If you have any question on what I've said so far, please put in the chat. If you think you've learned one or two things today, also, okay, yeah, I got a hand up there. Let me unmute you if you would like to talk. So allow to speak. You can now unmute yourself and speak.
Okay, hello, good evening.
Good evening.
Okay, so I actually listened to this same webinar from the recorded version on YouTube,
Yeah,
and so I attended today's own just so that I have the opportunity to ask you my questions
yeah, that's
real
good.
time. Okay, so I would say compared to the recording that I listened to, you spoke more detailed about the SEEP account on the recording than you did in today's class. And most of my questions come from what you said
Okay.
in the other class, but
Yeah, that's
it's
okay.
still applicable really. So I would like to know, you mentioned about doing a separate pension on the SEEP account.
Mm-hmm.
But from you had mentioned before that you mentioned something which I wasn't really clear on. If it's possible, so my question is on the sleep is it possible for me to get my employer to pay my pension into my SEEP account? And
Oh,
if yes, how do I go about doing that?
okay. Thank you for the question. So it is possible. For instance, I just this is an example of my employer paying into a SIP account for me. But you have to you have to be confident
Mhm.
that you can manage this better than those who are currently managing it for you. Okay, so if you are confident that you are able to manage this more than those who are managing it for you, which is what I have done really, which I did like almost 7, 8 years ago. I took control of my own pension and I've been managing it myself since then. Uh, they can. Now, not all platforms will allow that. So two ways. If you have a limited company, your limited company can pay into pension for you. Okay, if you have a limited company, it can pay into your pension for you. If you have an employer, if you are self-employed, so the money coming here, which I'm going to log into now, is coming from my umbrella company. So I work through an umbrella company, and then they have a pension for me. They have a pension for me with a next pension. It's another one which is a workplace next pension. They have an account with me with next pension, but I now did another one which is salary sacrifice, which uh, which is coming in here, which I started last year, and I'm managing it myself. Okay, and that is coming in here for me, and I'm managing it myself. So this is coming from an employer, and so if you want to do that, you need to talk to your either HR or whoever is in charge of pensions, and then they will advise you on which platform they recommended or which platform they allow you. For instance, I was restricted by my umbrella company to use this particular company, or that I would not have used them because this is the only account I have with them, and the fact that they'll be charging me uh, £3 £3 99 or so on my transactions. I didn't want to open with them, but I ended up opening it with them because that was the one they gave me. So ask your HR and ask for which company. If you want to do that, at which company are their what would you call it, recommended provider, and then they will let you know. So you can do that. You can bring your money into SIP. The SIP also is a pension. You can't touch it. Okay. And at times, and also I've closed down my pension account. At times, I work with multiple employers. So there was a company I worked with 5 years. After the 5 years, I closed down the account. I moved it to into my SIP account. I worked with another company for maybe 2 years. I closed down the pension. I moved it into my SIP. And so you can also do that. Even for your past pensions, you can move them into your SIP if you are confident you are able to manage them. Does that answer your
Okay.
question?
Yes, it does, but there's a part of the question that is not yet answered, and that's
Okay.
and I know you said you have you still had because during the your presentation you mentioned that we could continue with our employer and then
Yeah.
have a separate SIP account.
Yeah.
So if you have a separate, is that like so the employer one is running, and then you have your own one that I say it's more like saving for your retirement kind of situation, right? So
Yes.
it's whatever you put in there, that's what you're gonna get the tax relief. Is it tax relief you said on?
Yeah, you
Certain
get tax
percent.
relief on it. So let me go back and uh, let me go back to that page and I would explain that. Okay, so let's use this page to explain it. So
Mhm.
what I encourage people to do is I say keep your workplace pension because you're not yet, unless you are not yet a professional investor. Keep your workplace pension. Let your employer and fund managers manage that for you while you create a parallel account, a new account, which is a SIP account. And there, any amount you now have, you put into that SIP account. And now, if you across all your pension accounts, you allow 60,000 into that account on a yearly basis. This figure will change when you start earning to 50,000, half a million. This allowance will change. But before, I don't know whether we are at that level yet. But you have 60K that can go into or across all your pension, your workplace pension, and your SIP in a year. So any amount you put into it, you can get back up to 45%. So that is the government, because normally you contribute tax, contribute pension pre-tax.
Yeah.
So which makes it that it's tax, you remove it before they calculate the tax on your income. But in this case, because you are taking money out of your pocket into your SIP, you've already paid taxes on that particular money. So government
Yeah.
they attempt to give your tax back to you through this system. So any money if you earn between bringing back the tax, bringing out the tax bracket again, if you earn between 0 to 52,000, okay, making you a basic rate taxpayer. If you earn between 0 and 52,000, the platform itself will claim the money back for you. You don't have to do anything. They will top up whatever you put into your SIP by 25%. So they're giving you your tax back. But if you are a higher rate taxpayer, you earn between 52 to 125,000, you need to claim back additional 20% through your self-assessment. And then that will change your tax bracket. So what they've done for me, for instance, let's assume you put 5K into your pension during the tax year. They will calculate 20% of that and change this figure, your tax allowance from let's say 25% of 4K is 1,000. So that will become 3,000. So you don't pay taxes on the first 3,000 of your income the following year. That's what they normally do. They just adjust your tax relief. They increase how much tax free you're going to have. So if you earn above the 125,000 mark, then you get 25% back from HMRC, them giving you your tax back. And then you can keep running your once you retire, or at age 57, if you won't be 55 by 2025, by age 2028, by age 57, you can touch your pension. Now, across your pension, you are allowed to withdraw 25% of your whole pension without having to pay taxes. So I didn't explain that also. So let's assume your pension is 1 million. You can take 250,000 pounds out of it as bulk money, and you don't pay taxes on it. But anything you withdraw thereafter, you start paying taxes on it as per normal rate. You start paying taxes as the rate you have here. If that rate hasn't changed, so any money you withdraw, you start paying rate based on what we have here. As a normal person who is working, you start paying. So does that explain? Does that answer your question?
Yes, it does. It does. So can I ask my next question?
Yes, sure, you can.
Okay, I have two other questions actually.
Yeah, that's okay.
And both of them are on stock the stock ISA one.
Yep.
So you did an example of if I had, maybe for example, I had a recurring, I was saving into my stock ISA,
Mhm.
and I have like the way you have automated your own, you have arranged what enters into that stock ISA every
Yeah.
month.
Yep.
Before your money comes in, is already allocated to what
Yeah.
it's gonna do.
Yeah.
So if I have if I have something like that set up,
Mhm.
and of course the deposit is coming in, how does it work? Is it going to a particular company's stock, or is it that it's just going into the account? Or
Okay.
is all part of what you set up when during the masterclass thing, or
Yeah,
something like
it's part of what we set out doing in the master class. There's something called fractional investing, fractional
that?
shares.
Yeah.
Okay, so let me quickly explain how that works. So there's something called fractional shares. So let's go back to here. I have a list of, let me show you a list of some. Okay, for instance, we look at Tesla. Tesla is $700 a share. Okay.
Yeah.
If you look at Netflix is $1,182 a share. So, but what fractional investing will help you to do is to buy a fraction of this. You don't have to buy a whole. So you can buy $10 of this, and they give you 0.0018% of this particular share. And now, so the way we automate it is that you will have selected companies. Maybe you want 10 companies. For instance, I'm invested into about 140 companies across the world. Maybe you're going to start with maybe 15 companies or 20 companies. And so what you will do is the system, especially trading 212, will allow you to give percentage to each of the company. Let's say company A, company B, company C, D, so you can say this company should get 5% of the money I send there. This company should get 7% of the money I send to my platform. This company should get 2% of the money. This company should get 20% of the money. And this one should
Okay.
get 3% of the money. You'll have automated it that way.
Yes, automated. Okay.
Yeah. So once the
Okay.
money is, so you set up a standing order on your personal account. Once the standing order is the account, you'll have set the auto invest date. So
Yeah.
let's say money is coming first of the month. Maybe auto invest date is second of the month. By second of the month, if you put £100 into it, if you distribute the £100, give this one £5, this one £7, this one £2, this one £20, and this one £3. It will buy fractional shares for you on all the company.
Mm.
Do you get it
Okay.
now? And so you don't
Yes,
have to
yes.
do anything because, and you can go and adjust the percentage later. If you feel like, okay, I want to give this company more, or okay, I want to introduce a company F that would
Yeah.
do 5%, you can do that. Then you need to remove that 5% of these ones to allocate to this. You can go there and adjust it at any time. And that's what I call smart investing because it's passive. You don't have to get involved with it. It runs itself. You go there to check whether it has worked fine, and usually it will work fine. And then you can just go and adjust. If you want to adjust it later, you can adjust it.
That's super. Okay, that does answer my question actually in detail. That's good. So my final question would be on the dividend. How does dividend on the stock ISA work? Is it like a amount that is accruing separately from the stock value itself, or and like is it something that okay, this is profit I've made on the stock and the stock is still there, but this is money that I've accrued and maybe I can now use it to plow back to buy stock or something like that. How does the
Yeah.
dividend work?
So yeah, this dividend is a top up. So I've just opened Lloyd's Bank now. Lloyd's Bank will give you 3.9% dividend. So, and that is different from the fact that Lloyd's Bank have done 38% this year. Okay, so maybe you bought Lloyd's Bank October last year. So this amount is in pennies, okay? This is Lloyd's Bank is 0.8p. So
Okay.
p per share. Okay, so let's assume you bought it somewhere here. You bought it 60p, 61p in October 16 last year. Now this is October 16 this year. That 1p has become 61p has become 84p. So that is capital appreciation on your money, which is 38% on your money. That one is one. Then number two is the fact that you've earned when they declare profit, out of the profit they've declared, they will now give you 3.9% on the number of shares that you have. So that is based on how much you've invested. You get 3 point here, they call dividend yield. You get 3.9% dividend yield. That is in addition to the fact that your capital has appreciated. And the good thing
Is that a
about,
yearly
excuse me,
thing?
it's twice in a year. Well, this is a yearly thing, but it's paid twice a year. In the UK, it's paid twice a year. In America, it's paid quarterly. Every three months, you get paid dividend. You
So
get paid.
that's let's say that's 3.93%. For the one that's maybe for the UK that pays maybe twice a year. So maybe after the first 6 months they'll pay you one point something.
Exactly. You get paid that
Okay.
into your account, and then
Okay.
you get paid another 6 months into your account. So that's in addition. Now, the good thing also about trading 212 is that you can auto invest your dividend.
Yeah.
So as the money is coming in, for instance, this is one of my platforms. This is showing you how I receive dividend almost on a weekly basis. This is just a small account that has 14,000 in it or so, and see almost on the weekly basis I get a lot that I have dividend. That I have dividend. I get this alert of me having dividend almost on a weekly basis from that account, and it's even a very small account. And so it will auto invest. Some platforms, especially trading 212, which I think is the best, auto invest. So if I should get £5 dividend on Lloyd's, it will use to buy more Lloyd's shares for me.
Yeah.
But if you want to withdraw the money, you can withdraw the money. But if you set up auto reinvest, it will reinvest all your dividends for you into the company
Okay.
that gave you that dividend
Okay.
automatically. Okay.
Yeah.
Uh,
Okay. That's the last of my question, but you'll be
okay.
seeing me November 15th.
Oh, that would be good. I'll be pleased to. to take us through. So I have got a question here that says, please, do we pay tax on interest and on 2212, for instance? You do not pay taxes. So you do not pay taxes. So interest and let me switch to, so you have if you want to open, so you have all of this. These are the type of 4 accounts you can open with them. So do not open this one. This one is the general investing account. Okay, on this one you pay taxes on whatever you earn. This is a general investment account. You can put in 1 billion here, you can put 1 million, whatever you want into it. This is your ISA. This is where you can't put in more than, you can't put more than 20K in a year. And then this is your cash ISA, which where you can also earn, where you can also earn you say 3.8% interest is what you earn on your savings, and it's paid on a daily basis. So it's free. You can easily access your money if you want to. Unlike people that wait till the end of the year before they pay you your interest, you get paid on a daily basis, and you don't pay taxes on it, which is the question. Anything ISA, your lifetime ISA, your cash ISA, your stock and share ISA, your junior ISA, everything innovative ISA, everything ISA is tax free. That is accumulative. Is there a way to get HMRC to correct my tax code? Correcting your tax code, you can contact them if you think your tax code is wrong, and then they might actually be owing you money because they said it's our responsibility to go change to make sure we are being taxed correctly. So it's your responsibility to know that you are on a correct tax code and to be sure you are paying the right taxes. So you can call them. Google their number, call them up, and then they would correct that for you if you know you have a wrong tax code. And for some other allowances, like for those of us that use uniform at work, you can also call HMRs to let them know your subscription for your professional body. You can call them up to claim all of that back for trainings, professional trainings, for uniform, even try cleaning your uniform by yourself. You can claim all of those things back. If you call HMRC, they would over the phone. They can do that for us. Okay. Any other question? Okay, can I call them now or should I wait? I don't think they do 24 hours. I don't think they do 24 hours. You can do that in the, oh, you don't have to wait till the end of tax year. You can do that for previous years, up back to the last four. A lot of things you can do back to the last 4 years, or you can do it for this current year if you think you're in the wrong tax code, so that they can tax you less for the remaining part of the year. I think we're halfway through this tax year. They can tax you less for the rest of the year. Okay. Any other question, please? Okay, so it's 9:01. Okay, there's something. Do you have an accountant? Yes, I do have an accountant. Can I recommend? Yes, I can recommend. I just changed my accountant this year. So I have one in my local where I live in Staffordshire that is managing my account right now. Definitely, you can drop me a note after the class. My phone number is on the website where you registered from. I think if you go to use a contact, yes, my phone number at the bottom of the web page. You can reach me on that number. Okay, thank you so much for tonight. It's my pleasure having us all around, and do have a very nice evening. And I hope to see us in the master class coming up on the 15th of November. It's going to be the last one for the year. So let's get ready for 2026. Thank you and have a wonderful evening. Bye-bye.
Bye.
Yeah, bye-bye.